I've had situations where, due to whatever reason, somebody has invested and really genuinely forgotten about it. And the investment value was only say, 10,000 rupees. At the end, now, like this was in a particular case in the early 90s that gentleman invested. And now it has grown by maybe 1,000+%. Right?
Wow.
And he is so pleasantly shocked and surprised because he'd forgotten about it. But the mutual fund has kept on compounding and multiplying itself,
Right.
right? So he's in for a big,
Happy surprise.
Welcome to the Sum of Everything podcast, where we discuss a little bit of a lot of topics, ranging from spirituality to finance and everything in between. I'm your host, Aishwarya, a serial hobbyist with an unquenchable thirst for learning, especially through new experiences. In this podcast, we will scratch every itch of curiosity, explore various perspectives, step out of our comfort zone, and experience some of everything. Because after all, we are just that, a sum of all our experiences. So, let's dive right in.
Hello, and welcome back to the Sum of Everything podcast. Listeners, today's episode is part 2 in the Following the Money series, featuring my father, Mr. K. S. Rajan. If you missed last week's episode, I would highly recommend tuning into that before listening to this episode, because in last week's episode, we talked about my father's journey from a corporate life into following his passion in investment and trading. In this week's episode, we are going to be talking about personal wealth management and getting his advice on how to invest, who should be investing, where you should be investing, what kind of goals to set, and things like that. So that my father, who is an AMFI registered mutual fund advisor, can potentially give you tips and tricks on what you can do with your money and how best to utilize it to grow your personal wealth. So, welcome back, Dad.
hi, nice to be back. And it was nice last week sharing the details of my journey into the world of investments. Let's take it forward.
Right. Awesome. Great. So, we had a very interesting discussion last week, and we talked about your personal journey into investments and mutual funds and stock markets. This week, let's talk about the kind of advice you would give and the kind of advice that I have grown up listening to. And I think it would be very helpful for our listeners. So, let's start with the absolute basics. Who should be investing, and when should you start investing?
Anybody who wants to generate wealth for himself or herself,
Mhm.
regardless of the age factor, should be an investor. Now, you may find it a bit odd as to what is it that I'm saying.
Mm.
You have had situations in your childhood, and this will be true for almost all of us,
Mhm.
that you have functions, festivals in the family when the elders in the family give cash gift.
Right. Yeah.
So I would suggest that these cash gifts can be channelized towards starting the investment world. Traditionally, you have the gulak, the piggy bank, into which the money goes in,
Yeah.
right?
Mhm.
You collect a few hundred rupees,
Mm.
and these in turn can be used to start a mutual fund investment journey.
So you're saying that you don't actually have to be even 18 years of age to invest? Is that what you're saying?
Yes, that's exactly
Mm.
what I'm saying. Even as the small an age, like a couple of months,
Mhm.
once a name is decided upon by the parents for a newborn child, the date of birth is there,
Right.
you can start an investment in that child's name, in that infant's name. The father or the mother, the natural parent, becomes a guardian, and the investment happens with the support and through the parent or the guardian
Mhm.
in the name of the child concerned. So, and while the first investment can be some as large or small as rupees 500,
Mm.
subsequently can be done in the multiples of 50s and 100s. And it can be as frequent as a daily investment, a weekly investment, a monthly investment, or a quarterly investment.
That's news to me. So, okay, but I thought you needed to have something as basic as an account, a bank account, and a PAN card to start investing.
Yes, you do need a bank account and a PAN card. So, as part of this process, we we encourage our potential investors, I mean the parents who want to invest in their children's name,
Mhm.
to apply for a PAN card, even for a couple of months old child, and the address and the Aadhaar follows as that of the parent.
Okay.
So it is, while the investment comes from the account which is actually operated by the parent,
Mhm.
but it's in the name of a child, and the parent's name is also attached to it. So the real investment, real earning is that of the parent,
Mhm.
but the money gets invested in the name of the child. And once the child becomes a major,
Mhm.
then the responsibility of transactions and everything gets shifted to the name of the child concerned, who's now a major. So
Ah.
So there is no age that is small. No person is incapable of investing in his or her name. Only thing, investment decisions are made for by the guardian concerned. In this case, the parents, or in certain cases, in the unfortunate absence of a parent, by the guardian concerned.
This is interesting. I'm sure most of us, like me, didn't know that even children could invest or investments could be made in children's names.
Yes.
That's very, very interesting. So, okay, next part of my question. So, suppose let's assume that you are now a major and you've started working. I know personally when you think that we should start investing with our own money, but for our listeners' sake, what do you think is the right way to go?
So once you become a major and you have a source of income,
Mm-hmm.
it could be a part time or it could be a regular job,
Mm-hmm.
whatever the source of income, if a person has started earning, I feel that he or she should start saving maybe as minimal as 10% of the earnings
Mm-hmm.
or 20% of the earning, depending on whether you are staying alone and supporting yourself or you are staying with your family somewhere, in which case the savings level could be much higher.
Mm-hmm.
That should be channelized into mutual fund investment. Now, the difference between a fixed deposit in a bank or a mutual fund investment is that mutual fund investments seem to give much better, much higher return over a long term.
Mm-hmm.
So, the choice of vehicle for investment and generating wealth and creating wealth for yourself is that of a mutual fund. I would suggest to people and remind that the investment should start from the very first salary, very first job, very first assignment,
Mm.
right? Traditionally, the thought is that with my first salary, first income, I will use it to celebrate, to have a party, to buy gifts for myself, for my near and dear ones, and will postpone the investment journey, start of the investment journey to a much late date,
Mm-hmm.
right? The idea is to first reward myself with so many goodies that I have been hankering for.
Right.
In my opinion, there's nothing wrong in wanting to reward and give oneself goodies. But at the same time, it is very critical and very important to get into the investment mode, into the investment and savings habit.
Mm.
Nothing like starting from the very word go.
Can you give me an example of why that is important? Rather, can you give me maybe with some kind of a hard example where somebody who started saving from paycheck number one versus somebody who's waited a few years before saving and how that adds up and why that is important?
So I'll need to talk about a concept called compounding, right?
Right.
What happens is that if you start, let's say that there's a person, two of you are there,
Mm-hmm.
and one of you and both of you start in the same company at the same salary levels,
Mm-hmm.
at the same age. That let's say you start with saving 1,000 rupees per month,
Mm-hmm.
and the other person, and you carry on the show for 5 years.
Right.
So over a period of 5 years or a month means you have saved 60,000 rupees in a period of 5 years.
Right.
And that 60,000 rupees, if you were to say that it will give you at the rate of 10% per year, the
Mm-hmm.
first year saving of 12,000 rupees has added 10%,
Mm-hmm.
which will be
Adds up to
Yeah,
13,200.
yeah. So at the end of 5 years, you have actually put aside only 60,000 rupees, but it would have it would have added to a sizable amount.
Right.
Your friend starts after 5 years, after the 60th month, from the 61st month, he or she starts saving, let's say, 1,500 rupees per,
Right.
right? So in a span of the next 60 months, right, that person has added substantially much more than what you have added.
Right.
But when at the end of, say, 15 years, both of you look back, right, you would find that you have your value, the saving that you did in the first 60 months, and after which, let's say, you stop, and your friend started from the 61st month and carried on for the next 60 months, the amount that lies in your account credit is much higher than what your friend managed by saving from the 61st month to the 120th month, right? This is
Wow.
the power of compounding. So that's the reason why I say that start early, slowly and gradually, it will balloon into a huge and substantial value.
That's interesting because I just did the calculation and say if you're saving or investing 1,000 rupees per month for 5 years with an expected return of 10%, then at the end of that 5 years, you have returns of 18,000 rupees, which basically means that for the period starting the 61st month, which is when the friend starts investing, you are already earning returns or on 78,000 rupees,
Yes.
whereas that person is starting from
Zero.
zero. And that can add up to a very sizable amount, which we've seen. Actually, I've experienced it because I know that when I had my first job, you used to take out a sizable chunk from my monthly salary and put it into investments. And now I know that I could, blindly trust, and I knew what you were doing. So I didn't even think about asking until very recently what that money,
Yes,
came
yes,
up to.
yes.
But in a single year, say I saved about what? Let's say about
It was in the range of about 5,000 rupees per month is what we used to take out initially. Gradually, we kept on increasing by 2,000 rupees every month
right,
additional, and became
right.
7,000.
Yeah.
So it,
So now that like really ballooned, and today when I see the figure, it is in lakhs, which is so crazy.
yes,
And that sort of gives me confidence, and both it makes me a little bit happy because I know that I do have the tendency to spend my money. So the
big way.
discipline, yeah, the discipline that you have inculcated when you save before you spend, which is something we spoke about in the last episode also.
Yes.
You save first before you spend is very, very important. And I think it's a discipline that must be inculcated very early, if not right from the get-go. Now, next question here is there are different instruments of investments, right?
Yes.
We've talked about mutual funds, we've talked about fixed deposits, we have also talked about stock markets. Now, these are the three that most people know. What else is there, and how should you go about choosing where to put your money?
Since we are talking about, and when our listeners will be a cross section of the people across ages, more directed at the youngsters, I would say first and foremost, as part of the investment world and as part of the financial planning, which runs across for the entire lifetime, I would like to draw upon the concept of insurance.
Right.
In life insurance, health insurance, general insurance.
Right.
There are these three specific insurances that I would like to draw your attention. Life insurance is that if something unfortunate were to happen to the person concerned on whose life the insurance is taken out, then that person's nominees we named, they will get the proportionate value of the money insured.
Right.
So, for example, if there is a breadwinner or a person on whose earnings depends a certain set of people, then in the unfortunate event of something fatal happening to the bread earner or to the money earner, then the insurance company pays. So that is called a life insurance. The second insurance that I'm talking about is the health insurance, that in the event of a person falling sick, then in today's world, the financial cost of falling sick and medical treatment is quite costly and sad to say quite exorbitant. Then these medical insurance or health insurance comes into play and it's a major help. So that's another must. And the general insurance that I'm saying is more to draw upon as to what is the concept of insurance, because most of us, by the time you're an adult, you know that you have to insure your scooter, your car or something.
Right.
And in the unfortunate event of an accident happening, then the insurance company pays for the repair and maintenance of it. Though you do have to shell out a small value, a small percentage of that. So it's maybe 10% of it, depending on the terms and conditions.
Right.
The same thing is true for your health insurance and for your property insurance, house insurance and all. It's different. The moment a person becomes a breadwinner, he or she should start with these two insurances, health insurance and life insurance.
Okay.
Now, there is a concept of unit-linked insurance plan. Some health insurance companies, some life insurance company do offer saving, wherein they say that there is a money-back policy there. So you pay for maybe 3 years, 5 years, 10 years, and then after a certain gap, you start getting some money at regular intervals.
Right.
And the insurance companies do talk of you, instead of your money having gone waste, you do get back something. While to a person who cannot have the discipline of making regular investments, this could be one of the options available. But on a purely financial smartness ground, I would say I would not support this kind of a unit linked insurance plan or money back policy based savings.
Right.
While I'll say this is better than not having anything, but on a strict term basis, have a term insurance where the premium that you pay is much lesser and the balance amount of what would otherwise have gone into a unit linked insurance plan, which is what is called ULIP.
Yeah.
Right? So if a ULIP is that of 20,000 rupees per year, you can have a term insurance of just maybe 5,000 rupees and balance 15,000 can be invested in mutual fund. And your final savings or the value of your wealth or the money that you get at the end of 20 or 25 years in a mutual fund route will be much higher as compared to a ULIP link methodology.
Right.
But it is better to at least have a ULIP linked savings plan than not having
anything at all.
That is why take an suggestion to our listeners.
Okay.
So insurance, health and life insurance is one way, one of the financial instrument that is an absolute must.
Okay.
The usual instruments of savings is fixed deposit in banks, in private companies, and also in post offices.
Correct.
Then you have the mutual fund investments. Now, there are more than 1,400 options of investment in mutual funds.
Wow.
You have equity investments, equity-based mutual funds. You have debt-based mutual funds. You have commodities-based. You have hybrid. You have multiple ways of investing. Right? And each one has got a certain degree of expected returns, which is directly linked to the perceived risk value. More the risk, better is likely to be the returns. The longer you stay invested, the higher the benefits that you will accrue to you. Now, there are the other form of investment would be that you could invest in real estate. You can buy land, you can buy property, and though those are all not very easily convertible into cash during times of emergency, which is called liquidity. So liquidity is not easy with land or real estate or a flat, but they certainly over a longer period, say 10 years and 15 years, give you very high return.
Okay.
Often the equity-based mutual funds do match the return. In today's terms, I would say I give kind of an assurance. There is no guarantee, but an assurance, an indicative assurance or return of between 12 to 15% on the mutual fund return.
Okay.
Today, for a person up to the age of 60, the returns over a 3 to 5 year fixed deposit in banks is in the region of about 5.5 to 6%.
Right.
For a senior citizen, it is anywhere between 7 to 8%,
Right.
depending on the institution or the organization with which you invest.
Right.
So, as against a 6%, if you get 12% or 15% per annum,
Mm-hmm.
it is almost double, more than double the return that a fixed deposit gives you.
Mm-hmm.
And a bank fixed deposit is also directly proportional to the longer you stay invested in the fixed deposit.
Right.
So a 3 year gives you much better return, assured return as compared to a single year deposit.
Right.
5 year fixed deposit gives you better return than a 3 year fixed deposit.
Okay.
Same is the case with mutual fund investment. The longer you stay invested, the higher is the expected return.
Yeah.
That is the beauty of the investment journey. So you start early, stay invested, maintain your wits about you, even when the market seems to be falling. And at the end of 5 year, 10 year, 15 year, 20 year journey, you find that you have made phenomenal return.
Okay. So I see that a lot of what you've said just now was very catered towards staying invested in the long term. But like any person would have short term goals, medium term goals, and long term goals. So, for somebody who's looking to stay invested according to their goal, what would you advise is the best strategy to follow? Would you say that everything should always go into equity, whether it is stocks or mutual funds? Or would you advise, what's the word, advise on diversification? Because a lot of people generally advise diversification of, putting your money in and dividing it into debt, equity, as well as gold, like that.
Yeah, very good question. See, this is what you're saying is referred to as asset allocation, right? And balancing your assets at the
Right.
right time. So the concept goes like this, that 100 minus your age, whatever is there. So typically, if you are in your 20s, say you're 25, then 100 minus 25 means 75. So this is 75% of your assets you invest in the equity. That is, could be in shares or share based mutual funds, equity investment mutual funds. And the balance 25 you allocate towards debt or hybrid funds. So now in this case, in the debts or hybrid, you come across commodities funds, you come across gold, silver, metal funds, or high end metals, and the pure debt funds. That is, the mutual funds invest in bonds, in fixed deposits of AAA rated, AA rated corporates, and they manage it for you. So it's a combination of equity, debt, commodities, gold, silver, and what have you. And also nowadays there is this concept of REITs, real estate equity investment trusts and all. That also is another instrument that is available, which is an extension of the mutual fund world. Have.
So REITs are essentially similar to mutual funds in the sense that you could have a monthly amount that you invest in them, but the companies or rather the trust that you are putting your money in are investing in real estate.
Based companies and all,
Right.
right?
Okay.
That's how it is. You also have another option these days, and that is NPS, National Pension Scheme.
Okay.
So these NPS license or investment is routed through existing mutual fund companies. The government has authorized and licensed certain companies. You have an HDFC, you have an ICICI, maybe Aditya Birla, ABSL. These are all two or three, and some more are in the pipeline. So you invest your NPS and they give a choice how much of it you want it through equity, how much of it in debt you want it. So it is straight away related to your preference of risk and perceived return. You have NPS, you have the same mutual fund people who are authorized to act and guide and advise for mutual fund NPS investments also as in a mutual fund investment. And so that is another option with a very attractive tax saving factor attached to it, especially for the salaried employees.
I'm glad you mentioned that because we will come to that. But just before that, just to make it clear to our listeners, what would you categorize as short, medium, and long term goals? Or what is the time period that you will categorize as short, medium, and long term?
It depends on the kind of goal that you set. So if you are planning to have next year, wanting to save for an admission into a special course, it's a short term. Anything up to 1 year or 2 years is actually a short term. Anything 3 years and beyond is what I'll call medium term, up to 5 years. And beyond 5 years is what I'll call maybe 5, 7, and beyond is all long term, right? So then how is the investment different? No, it depends directly on your risk taking ability. For a person whose thought is that he or she, everyone thinks of himself or herself as a high risk taking person till the time the crunch time comes. Then the person, many people, they develop a cold feet. So there are various tests and various ways how a mutual fund advisor or your financial advisor will put you through to assess your risk taking ability and to put you into the right pigeon slot. Whatever the test shows, I would always peg a notch lower as the real risk taking ability of that person, because it pays to be conservative on that front, right? So if I am a very high risk taker, then I would put unduly high percentage of my investment into equity and equity based instruments, because that will give me that kind of a higher return, which is what I'm looking for. There is nobody who does not want a higher return, but the risk taking ability and the ability to stomach the uncertainties and the gyrations of the market is what will dictate how you respond to the stimuli of the falling graph of the performance of your investments and the portfolio. So if you are able to maintain your wit and not do anything which can be detrimental to your portfolio, then you are the right person to invest in a high risk portfolio. So that leads to a question. What does a person who would like to have a higher return, but whose status in life is something which is not very friendly to taking risk? Let's say a retired person who is in his or her mid 60s, who doesn't have any other source of regular income and who depends on his or her saving. In which case, we would say that that person is not to be slotted into any investment which is high risk. But then, how does that person get a better return? That is when we go in for something called a balanced investment or a hybrid investment, which will have a combination of debt, equity, yield, and a combination of commodities and all. And the fund manager will have an eye on safety of the investment, the invested capital, as the first criteria. Right. And then look at the return as the next priority. Right. So this gives you, when we do a back calculation, when we look at the trend till now, these funds gives you certainly a slightly higher return than a bank fixed deposit. Right. So these are ideal for a person, retired person, to take on a monthly basis. And mm, there is this concept of systematic investment plan on a monthly basis, meaning that a fixed amount is put on a given date as an investment. The reverse, which is SIP, right, systematic investment plan. The reverse of it is you systematically withdraw, SWP. So if I'm a person who wants on the second or third of every month a fixed amount, let's say 50,000 rupees every month, to carry on my life smoothly, and I'm a retired person, I don't have any other source of income. So then the mutual fund investments are structured, mutual funds, fixed deposits, and what have you, is structured in such a way that during that given week, regularly money comes in from my investments. The balance money keeps accumulating, keeps growing in value, and I keep withdrawing every month through a mandate or an instruction given to my institution where I have done the investment. So they will see that that much fixed amount is credited to my account to carry on my life in a smooth fashion. This is called SWP. This is recommended for person who have no other source of income, or who already have a source of income, something else, and want to supplement it to maintain a certain standard of living. Right. That's how this works.
Interesting. Hmm. Now, I have a question regarding people more my own age. So let's say mid 20s to and people in their 30s, right?
Right.
Now, you did say that the real estate is a really, good investment in the long term. But staying in the market can assuredly give or match returns of real estate. Now, when you look at the last, say, 15 years or so, people who are or who have been in their 20s or 30s in the last, say, 10 odd years, at least have very different goals than, say, people who were 30, 20 years ago or 30 years ago, right? So when you were 30, you had very different goals than today when I am 30. Potentially, when you were 30, what you were looking at was buying a house and settling the family down and buying a vehicle so that there is mobility for the family. But today, a lot of people my age are, number one, choosing not to have a family, or number two, choosing to not invest in a house, and they prefer much more to have a rented accommodation where buying a house is not necessarily a goal. They prefer to have different experiences. Like most of my friends prefer or want to have a fund or savings for experiences like concerts or traveling and things like that. So, how would you say the investment strategy differs for goals like this and for a life outlook like this, as opposed to something more traditional or conservative?
All right. Yeah. So I need to go back a few decades. So in the 70s and 80s, when you look at it, it's a question of the society as it existed and in the context of the Indian economy as it existed.
Yeah.
We are talking about a time when my elders and my parents, they did not have so much of awareness about the options of savings and wealth generation. That is when my father and his colleagues, they only looked at bank fixed deposits and post office savings as the option. And it was a time when loans were hard to come by. A person had to first save and then they could go in for acquiring any kind of asset. To buy a bicycle or a scooter, which was a real luxury then for an upper middle class person, he or she had to first save because there was no way how they could get a loan.
Right.
As compared to today's situation, which changed about 20 years back, where the prevalence of credit card, the credit culture has now is a very common sight in Indian economy, Indian market, and to the generations, yours and the earlier ones, those who came into the working life in the 2000s, the turn of the century. So now it's very easy for a person with just a year or two's experience to get a credit card for himself or herself
Right.
and to buy things on credit and make a monthly installment. This comes on the back of the situation where maybe 70-80% of today's youngsters will will have grown up living in their own house now,
Mm-hmm.
or currently, in the last 10 years, their parents would have acquired a shelter and a roof of their own. So that is not the first priority for them.
Mm-hmm.
Right? Whereas during the time when I was a youngster and a student and coming into working life, it was a very rare occurrence that I would find that my parents had managed to acquire a shelter of their own.
Right.
So we have this, we've heard, you may have heard roti, kapda or makan. So
Right.
now what has happened is roti, kapda or makan, all three are now taken for granted by the youngster. So it leaves the option of getting into the experiential, lifestyle.
Mm-hmm.
And that is not a long term. That is usually a short term or a medium term
Correct.
goal.
Correct.
The medium term goal would be that if you want to buy a real high end car for which you already have a car, you want to buy a real high end car. So you are ready to wait for maybe 5, 7, 10 years,
Right.
which is highly unlikely because if we think of a car, you may not wait for it. So maybe I should correct myself. Maybe within the next 3 to 5 years, you will want to buy a car.
Right.
Going on for a saving for a concert, wanting to attend maybe a BTS concert, if it so happens in India or somewhere nearby, or one of your other favorite bands or experiential situations
Mhm.
would happen in the next 1 year or 2 years time.
Yes.
So you will save for that. So that's a short-term goal. But you take it this way that your risk-taking ability is also that much high. So how
Mhm.
do you define that? What does it mean, risk-taking? Risk-taking for me is different than the risk-taking for you. For a person who's in his 40s and 50s, there already is a set of responsibilities that that person has to undergo,
Correct.
whether he or she. He invariably, that person knows that he or she has got not more than another 10 or 15 odd years of productive working life.
Right.
So he or she has to save and keep the kitty ready for for the time when their productive years of getting income is dried up.
Right.
So they have to save for the lifestyle that they want to maintain without any hardship.
Right.
So they don't want to take a risk. Whereas a person who's in his or her 20s and 30s still has got another 20 plus years or 25 plus years to go. So if, let's say, a 5 lakh amount is there and which falls in capital value,
Mhm.
the impact of that or the hurt sentimentally, emotionally, and financially will be much lesser to that person who's in his or her 30s as compared to of the same thing happening to a person who's in his or her mid 40s or 50s.
Right.
Right? So this is what I call as the risk taking ability. So a youngster will have a series of short-term goals. It could be wanting to buy a car maybe in the next 2 years' time, wanting to go on a foreign trip or in the next 2 years' time, wanting to save up for an occasion like a marriage that is likely to come in the horizon in the near future. So
Yeah.
these are all short-term goals,
Yeah.
right? So it's a combination of they say that I want to take a higher risk, but I want a higher return. And what if it doesn't give you that? So typically I've come across situation a person says, will my money become zero? No, highly unlikely. So what is that I do? So if you go this route, you may get a 20% return in a single year, or you may suffer a loss of 10%. So are you okay? If that person is ready, then he or she takes a plunge of putting that investment into that kind of a risky investment, which would be pure equity based. And within the equity base, you have a flexi cap, a momentum cap, large cap, a mid cap, a small cap, a combination, hybrid. So there are maybe 8 to 10 different types of investments, schemes in mutual fund.
Right.
So you invest it. So your willingness to accept that kind of a risk after discussing and after going through this kind of a discussion with your financial advisor, you choose the path, and that will give you the expected return. If you say that no, I'm not, I want to be very sure because this money that I am now staking is for my college fees that I am going to go for a higher studies to within the country or outside the country. And for that, this saving is done. Then you want to get a better return than what you would get in a bank fixed deposit, but want a higher return slightly. So you go in for that kind of a balanced investment or a hybrid fund, which will give you a lower return, but the risk is much less.
Understood. So essentially, it depends entirely on your risk taking profile and what, of course, the period in which you are expecting to meet that particular goal that you have.
Yes.
Okay, interesting.
So a person can have multiple goals. So you can have a goal based investment. So, for example, you have one goal of going for, let's say you want to go to visit Singapore next year, and you expect to spend maybe 2 lakhs for that, tickets and stay and what have you there. So you will say that, okay, I'll save maybe a sum of 20,000 rupees per month, right? So at the rate of 20,000 rupees per month in a span of 12 months, you would have put aside 2,40,000 rupees, which with a growth will grow into maybe 2,75,000 or maybe 3 lakhs, right? That is one, can say, pigeonhole or one bucket. You also are getting ready for a marriage, which could be 3 4 years down the line. And for that, you want to have maybe 5 lakhs or so. Then you could have another investment, another monthly investment, SIP, worth maybe 30,000 rupees. So for your Singapore visit for next year, you have 20,000. For your marriage saving, you have 30,000. And you could, so 20 plus 30 is 50,000 rupees, right? And you could have another investment of maybe for your retirement kitty. If a youngster were to come to me, I would say that don't postpone planning for your retirement when you are in your 40s and 50s. Start now. Start with a 5,000 or a 10,000, but you will not touch that till your actual retirement age. By when it would have ballooned into a substantial value with a
Right.
phenomenal growth.
Right.
So 20,000 rupees for your Singapore visit, 30,000 rupees for your planned marriage, which will be 3, 4, 5 years down the line,
Right.
and another 5 or 10,000 rupees for your retirement.
Right.
Right? This is how it can go. Once you get married and a person's status changes, then he or she might have new challenges, new responsibilities coming the way. That could be a child, so the child's education, saving
Right.
for his or her thing. But by then your Singapore visit would have gone, by then your wedding would have already taken place. So that gets replaced by a new challenge. The new goals would kick in. So
And you're
that same
also,
will-
and your income has also probably increased
Oh,
in the
yes.
last few years.
Oh yes.
So
Oh yes.
that also contributes to how
Yes.
much you can actually
Yes.
invest.
So every time you get a bonus, every time you get an increment, my suggestion would be that a person should keep increasing or her kitty of investments.
Right.
To the investments.
Right.
And in a story like way, we tell to a middle-aged person that if you have one child, anybody who has had a child and who's been a parent or who's seen a child being reared up in his or her house knows that the parents and all the seniors, they don't hold back on spending for the comfort and the upbringing of the child. So if in a month you spend say 30,000 rupees on the child's upbringing for the well-being, on the new dress, toys, or goodies and food for that, we say in the mutual fund world, please think of your mutual fund investment of yourself, your retirement as a second child. So if you have spent 30,000 rupees for that child, spend another 30,000 rupees for your retirement. Because remember, you are going to be the child in retirement. At that time, instead of turning to your near and dear ones, maybe your own children for support, it is always better that you hold up on your own and manage your own finances with your head held high. And that doesn't mean that your children will not or cannot support you. But it always is better to delve into your own earnings and feel proud about it rather than, have the unfortunate situation of not having enough and looking wistfully to your near and dear ones for any kind of support. So I say that right from the word go, give enough importance to your retirement kitty and keep planning for that.
Yeah, that
And
makes
never
sense.
stop saving that. And do not think that I have enough time. I'm still in my 20s or 30s. I still have another 20 plus years. I'll start saving now. There is no need, no urgency. That could be the biggest mistake a person would do.
Right.
Postponing the start of the savings for his or her retirement is the biggest folly a person could do.
Very interesting. Okay. Now, I want to go back to something that you had said earlier, which was related to the taxation of the returns that we get. So we know that fixed deposits or the debt component of any investment, the returns from a debt investment, debt related investment is taxed differently. And the returns from short term capital gains and long term capital gains are taxed differently in when you put them in the market.
Yes.
So keeping that in mind, including say for short term, medium term and long term, what would you say is, say, for tomorrow, I have a BTS concert I want to attend in 2026, and say I want to start investing for it now. Where would you suggest I put in my money, considering the fact that in the debt component of it, I am taxed according to my tax bracket and where I fall? And in a medium and long term, or sorry, in when it comes to the investment
I
in
got
mutual
you.
funds, in short terms, I am taxed at 20%, whereas in long terms, I'm taxed at 12%. So
12.5%.
12.5%. So
Color doesn't have any money. Understand?
money doesn't have any color.
Oh, sorry. Money doesn't have any color.
Right.
So whether it is a short term or a long term, that the goal, you have labeled the goal as a short term or a long term. but your investments could all be under a single umbrella. Only that the time when you withdraw is the quantum that you will withdraw for that particular need. So first is, let us get back to one basic that I would say, that your investments in methodology or instruments other than mutual funds and shares are taxed at your normal rate of taxation. That is, that if you come under the 10% tax bracket, 20% tax bracket, 30% tax bracket with cess and tax and additional thing as applicable, your interest that you get from fixed deposits from other source will be taxed at that value, which means that it gets added. Your profits from that gets added to your normal annual income and you're taxed accordingly. Whereas in your investments in mutual funds and share market earnings are taxed depending on whether that instrument has been held for less than 12 months. That investment is, if those that are held for less than 12 months is called short-term capital gains. That is, for those that are less than 365 days is called short-term. And the earnings, the profit that you get out of it is taxed at 20%.
Right.
Those that you hold, the investment that you hold for 366 days and more are called long term, and they are taxed at 12.5%. Right? A person who, and now in this year's income, as per the income tax laws that the finance minister has announced for the year 25-26, financial 25-26, up to 12 lakhs, there is 12.75 lakhs of salary income, there is likely to be no tax.
Right.
As per the new scheme. And whichever way when you compare, the new schemes to be far superior and beneficial to every person as compared to the old scheme.
Old scheme.
So all our discussions will center around the new scheme.
New scheme.
In the old scheme, you used to have equity-linked savings scheme or the tax-saving mutual fund investment. Now all that is redundant. Similarly, earlier you used to have some benefits for taking life insurance policies. That is not there. Earlier you used to have benefits for taking health insurance. Again, that is not there. Right? So under the new scheme of taxation, Income Tax Act, there is no benefit for any of these schemes. There are no discounts or no rebates. Straight away, it is, you get 12.75% lakhs as your income. Up to that, there is going to be no, provided this income of 12.75 does not have any part coming out of mutual funds or share market. Right? Anything from share market or mutual funds is treated separately, and it is taxed at 20% if it is short term and 12.5% if it is long term. But to substantiate, I believe that it is better to have your investments in mutual funds and in the share market, especially if it is long term. The reason is that if I earn 30 lakhs or say 40 lakhs from share market or mutual funds in a year, I will, in a long term, I'll only have to pay 12.5% of 40 lakhs. Whereas if it is a 40 lakhs from salary alone, then I will pay 30% plus cess, surcharge, whatever you have, and it will end up in the region of about 33% or 34%. Right? So given this kind of a situation, being getting your earnings out of share market, on the taxation front, it is relatively much friendlier. So for a long term, and also till the time you don't remove that money, it is not taxable. It doesn't become your income. Whereas in a fixed deposit in a bank, even if it is for 5 years, at the end of every year, the bank computes the annual return and notionally credits it and deducts TDS on that and deposits to your tax department, which in your return you are expected to claim back.
Oh, this is news to me.
So I've had situations where some of my clients are bank employees and they have not been aware about the pros and cons of investing in fixed deposits versus mutual funds.
Wow.
And when it has been pointed out to them and substantiated with experience, they have also, become a fan of investing in mutual funds.
Mutual fund. So essentially what you're saying is, when you're getting, say, 4.55% interest on a fixed deposit, not only are you losing money because the inflation rate is higher.
8%.
Yeah, 7 or 8%. So based on the time value of money, you're losing money
Yes.
by putting your money in fixed deposits.
Yeah.
But also at the end of every year of your fixed deposit, you are eh, paying tax on money that you don't really need to pay tax on.
Yes.
Which beyond a point, you might not know you can claim, and B, you might forget to claim. C, you might not have an opportunity to claim beyond a point.
Yeah, if you are very alert and diligent enough to file your returns on time, you can get this back. But you understand, the deductions are made every quarter, and when you file your return, that is at the end of the first quarter of the following year. So for the good 12 months, you have not had the opportunity of making use of the money. It is not compounding at all. It is lying in the government coffers. So for a period, it could be 3, 6, 9, or 12 months. Government is enjoying
The interest on
interest on the TDS, the benefit of the. You
TDS.
don't get that. Whereas in a mutual fund, even if it is 20 years and you've not touched it, which is likely to happen for your retirement fund and
Right.
kitty and all, till the time you don't start removing it, you don't pay any tax on that.
Correct.
So I've had situations where, due to whatever reason, somebody has invested and really genuinely forgotten about it. And the investment value was only, say, 10,000 rupees. At the end now, like this was in a particular case in the early 90s that gentleman invested. And now it has grown by maybe 1,000+%. Right?
Wow.
And he is so pleasantly shocked and surprised because he'd forgotten about it. But the mutual fund has kept on compounding and multiplying itself,
Right.
right? So he's in for a big,
Happy surprise.
happy surprise. So
Yeah.
it's a manna from heaven for him.
Yeah.
So windfall. So that's what I'm saying. And
And at the end of all of this, you're still going to be taxed at the current rate at which
you have
on
the
the day
option.
you
After retirement, I don't have any other source of income. And it depends on the current income tax rules. But at least till now, I'm not paid. I may still be asked to pay because long term will be there, only 12.5%. But I have already had enjoyed the benefit of not having to pay anything on this compounding for the last 20 years or 15 years or 10 years, as the case may be.
Right.
And if at that time, or once at the time of retirement, if the government rule says that, listen, regardless of the source of income, whether it comes from share market, mutual funds, or wherever, if your income level is, let's say, below 12 lakhs or below 15 lakhs, no, you are exempted. Then it's an exempt in every way. So I stand to benefit out of, right?
Wow, this is excellent. This is really, I hope our listeners take away something from this, because this, despite having grown up with you in the house talking about all of this, I have learned new things over here. So I'm sure our listeners also will learn a lot. But wow, this has become a really, really long episode, and I think easily one of the most informative episodes we've had so far.
I would look forward to some feedback and lot of questions. It could be on so many facets, because there's a certain limitation to the talk, how long we can do. So based on that, if I were to give vent to my whatever ideas come in, could be a 2, 3, 4 hour episode, but we can't do it.
Yeah.
So I would say rather wait, let the questions come, and then we could respond to them accordingly based on the feedback, based on the questions and all.
That's awesome. And I think that's an idea. So listeners, if you have any specific questions, please write to us. What I can do is I can make a Google form and link it in the show notes. So if you have any questions, drop it in the comments section or in the Google form that I link. And we will either have a separate episode where we get back to you, or Mr. S Rajan himself will write to you. So we will figure that out. But please do not hesitate to write back. And if you have any questions, please feel free to ask. But with that, we will bring this super exciting and super informative session to an end. Do you have any last words for our listeners?
Start early, get into the world of savings and investment, and let it flow. Do not interrupt, do not stop. And especially now, when the markets are down, right? There is a major big sale that is going on. It's like saying that when we have a festival, a Diwali sale, or you have on the Amazons and all, Republic Day, Independence Day sale, and when there is 20, 30, 40% discount on some items, we buy it and say that I can gift this to somebody, I can use it for any other occasion, but at this rate, I don't get it, and we get into it. Something similar is happening in the mutual fund world and the share market where the markets are down. Excellent companies, they will not close down, they will only go up again. But now, low prices means you get more share, more value for your buck. So get in now. When the market is down, invest now. Don't bother, it may fall another 5% tomorrow, but there will be a U turn very soon. And when it happens, your today's investment of 10,000, 50,000, a lakh of rupees will be worth much more when the market finds its regular levels, which will happen in a couple of months' time. So go for it. All the best. Feel free to contact Aishwarya and me for whatever you want. Happy investing, happy wealth making.
Happy wealth making. And with that, we will bring this episode to a close. Thank you so much for this really long and really informative episode. And I hope the listeners liked it. Please feel free to comment, give us feedback, and get back to us in any way you can. And I will see you in the next one. Bye bye.
Bye.